Attitude to investment risk is one of the trickiest issues that financial advisors face. It's been at the heart of a number of mis-selling scandals in the UK financial services industry, and it continues to trouble advisors every week. Every time they consider the investments that are appropriate for their clients or other courses of action they should take, they are faced with the question of what is the customer's real attitude to risk. When I first encountered the financial services industry in the early 90s, I found firms using rather basic scales of high, medium, and low risk. And that immediately drew attention to a problem with the system being used. First of all, at the bottom end, there was no risk category. That came up to the fore in a string of disputes and fines and ultimately a Court of Appeal decision concerning the AIG Enhanced Fund following the 2008 banking crash. Essentially what happened was Mr. Rubenstein sued successfully HSBC because of advice they gave him to put his money into this fund, when actually what he wanted was something akin to a deposit account with rather better tax treatment and perhaps a bit of growth prospect that you wouldn't find from conventional interest. HSBC was successfully sued because they didn't actually provide that. And when the fund started to get wobbly and turned out to contain quite a lot of subprime mortgage debt and various other rather strange securities, you can see why Mr. Rubenstein was a bit upset, which is a bit of an understatement. In fact, it's quite difficult to describe what we mean by low risk. We mean sort of some risk, that's sort of implied, but many customers who think of themselves as low risk don't think they're taking any risk at all, which is quite wrong. And many advisors have to explain to customers that's not what it means. You do have to have a no risk category. At the top end of the risk list, you have high, but in a case I was involved in as an expert witness with my friend Roger Grenville-Jones, the Supreme Court of Gibraltar actually agreed with something I said, which was that the addition of a foreign currency loan used to fund the purchase of BBB corporate bonds turned a high-risk transaction into a spectacularly high one. So there are lots of levels between high and over the top. The judge said not all high risks are the same, and he meant it. And while we're on the subject of very high risks, there is a tendency to take customers who describe themselves at the top end of the risk level and recommend rubbish to them in the guise of being high risk investments. Rubbish is rubbish, and you don't and you can't justify recommending it just because a customer is prepared to take a chance, having appreciated that higher returns tend to come from taking greater risks. The Van Geen's case also exposed a second problem with assessments of risk, and that is the way in which suitability has to be achieved both objectively and subjectively. It's all very well saying what the customer would like, but if their circumstances do not render it suitable, it doesn't make an unsuitable recommendation okay when they say that they want to take some risks to achieve higher returns. In the Van Geen's case, Roger gave evidence that was believed by the judge and by everyone else in the courtroom that Mr. Van Geen's actually didn't have the competence to handle his existing portfolio, with which he actually declared himself more than comfortable and cross that it had effectively been lost in the transaction. Roger's view was that he should actually have had a lower or different type of investment holding that he could manage more effectively, bearing in mind that his levels of understanding of what was going on. One other problem with risk profiling is the weird way in which different people have totally different attitudes to risk in a variety of different parts of their life. It's very common. For example, I don't like debt. I grew up that way. And so my attitude to debt is absolutely zero. I don't want to take any risks. I'll pay my credit card bill at the end of the month and sometimes slightly early. For that reason, that doesn't make me a low-risk investor as regards my surplus cash. On top of that, you get customers who are in public sector final salary pension schemes and keen to retire slightly early by added years, so they retire on full pension slightly before they have done their 40 years of service. These people are being incredibly cautious about their pension, but it doesn't make them cautious investors as regards their surplus cash. And when they do other work for which they make pension contributions, typically because it's sensible from a tax point of view, and also because it's an available option to increase their retirement income, they can take a bit of a punt and be quite high risk because they've already secured their base level of pension income. You can see that the different areas of people's finances may generate very, very different attitudes to investment risk. A pretty classic mistake made by a lot of advisors is to take a position on the customer's attitude to risk. We can say, for the sake of argument, although it is a pretty artificial argument, the customer is 55% on a scale of 0 to 100 in terms of risk. The advisor recommends cash or very low risk investments, say between 0 and 20% on that scale, and to balance them out, recommends funds that fall in the 75% or 80% range. When those higher risk products fail, there is a problem for the advisor because the customer didn't accept that they wanted to take such risks with any part of their investment. Unless the advisor has gone through this properly with the customer and discovered the customer is prepared to take those sorts of risk to achieve the higher returns from the higher risk investments, it's the investor's fault. It's not, it's the investor advisor's fault, actually, and disaster follows. The next problem is that we all have different attitudes to the objectives of our investments. This was at the heart of the mortgage endowment scandal. Plenty of the people who took out an endowment, which is essentially a life assurance savings plan, would have had the right attitude to risk for the investment funds chosen if we were talking about their surplus cash. Unfortunately, we weren't. Mortgage advisors were talking about building up a fund to repay the loan on maturity. And many of the people involved didn't want to take a chance that their mortgage would not be repaid at the end of the term. And why should they have taken such a chance when there was a product, admittedly more expensive typically, a capital repayment mortgage, which pretty much guaranteed, if you kept up the payments, that at the end of the term, you wouldn't have a mortgage. Objective risk, as we could call this, does have an opposite side to it. You get customers that want, typically older customers, who want to put away some money, invest it, in the hope of using it to pay for school fees or university costs for grandchildren. These are sometimes very wealthy people who frankly can afford to pay these costs as and when they arise from either income or other investments. They can frankly afford to take a bit of a chance on not achieving the objective that they had in mind. And so their attitude to risk with that objective could be quite high. And it would match their objective suitability, if you like, or their objective attitude to risk, because looking at the available cash, they really can afford to take the chance that something might go wrong, because they'll still be able to pay those school or university costs as they always wanted to do. There's one last area where the investment advisor needs to assess attitude to risk, and that relates to the actual amount to be invested at the moment in question. An issue does arise with inheritances. People are quite strange and quite erratic in their attitude to money that they didn't earn. Some take the view that it was Auntie Julia's and it's very, very special and it mustn't be jeopardized. Others take the view, well, it wasn't mine, I didn't earn it, so I can take a bit of a punt on it in the hope of making a lot of money. Unless you ask the customer what their attitude to that particular investment is, you will get it wrong, or there's a fair chance that you will get it wrong. But it's true in all walks of life and all moments of life, because people come to financial advisors sometimes with a specific amount to invest, and that might have come about for reasons or generate feelings that are quite different from what the customer feels about the rest of their investments. Could be any number of different reasons. There's no point in trying to list them. It's the investment advisor's job to ascertain not only what the customer's general attitude to investment risk actually is, but what the customer wants with the money and what attitude to risk they have with respect to it. So we've got a range of different attitudes to risk that we have to assess. We do have to assess an overall attitude because it does give you a sort of picture of sorts. But really, we're always looking at the different areas of the customer's finances and appreciating that they may have utterly different attitudes to risk in those different areas. We don't want to go beyond the levels of risk that the customer is comfortable taking with any aspect of their investments. And we want to reflect the customer's attitudes to the objectives that they have for investing and the actual investment in question. Against this background, there's an awful lot of discussion at the moment about psychometric testing. It makes me feel profoundly uncomfortable because it typically produces a number which represents an attitude to risk across the board. So it doesn't differentiate in the way I've suggested that financial advisors really ought to check on the customer's attitude to risk. There are other reasons for concern about these tests. One is that it's well known that a bad experience in the stock market, if the customer follows such things, can generate a reduced attitude to risk, lower sentiments about risk, and also personal or financial difficulties at a given moment in time can do the same. These results are not consistent with given individuals over really quite short periods of time, which gives rise to concern as to how reliable they are. In fact, they can be used unfairly to beat up advisors. If a customer produces a much lower risk result than their existing portfolio, this raises questions about whether or not the customer really should have ended up in the investments they were in at the time when they were recommended in the past. And it also asks questions of the advisor as to whether they shouldn't change the investment risk profile and portfolio that the customer has. This might be quite the wrong thing to do. But more seriously, unreliable assessments of customers' attitude to the various risks that they encounter financially could be disastrous for both customer and financial advisor. What we really need is a much more nuanced approach to this subject than a simple test. And above all else, can we please get rid of the high, medium, low attitude to risk tests? They're profoundly inaccurate and they cause all kinds of problems to the financial services industry and its customers.